you able to see the screen? No. Okay, then I'm gonna put up the YouTube. Okay. All right, how are you feeling, Yulin?
I'm excited, of
Excited?
course. Yes.
Okay, cool. All right, we're just getting started and getting ready, guys. Thank you for joining us today. Good evening to you all. So we have an exciting new webinar format as well as content. So we have Endowus live webinar today on the US elections and the impact that elections has to financial markets. And I'm really excited to be joined by Yulin, who is our investment lead. Say hi to everybody, Yulin.
Hi everyone. Hi. So I am Yulin, and yeah, I'm very very excited to finally have a chance to interact with all of you guys through this platform. Yeah, should I introduce myself?
Yeah, sure.
No?
Why don't you?
Okay.
Go ahead. Yeah.
Okay. So I joined Endowus recently, and I've been enjoying this journey. And so previously, I was working for asset management company called AQR Capital Management, and I was mainly serving kind of institutions, their investment and portfolio monitoring as well. And that kind of, I think, led me here because I realized individual investors are kind of underserved in Asia, and I think I experienced the same pain points as all of others in Endowus. I think Sam has mentioned that a lot of times. Yeah. So I really think, this is a great mission to be on, and it's very, very meaningful. And here I will be, working very, very closely with Sam on all the investment-related stuff. So I really hope that we can, continue to serve all of you and to make investing better and easier for you.
Yeah. Apologies for the audio. It might be because of the aircon, so we turned it off. So bear with us if we start sweating. So thanks for joining us. We have a disclaimer that we need to show you all before we get going. And then another plug for our YouTube channel, Endowus Live. So you will see some of the webinars that we've been doing recently, and exciting ones. We had one last week with Lou, our dear friend from 1M65, on how you can manage your CPF to become a multimillionaire. So 1 million by 65, 4 million by 65, and using Endowus platform to manage your ordinary account. He thinks that together with your spouse, you may even be able to reach 5 million. So please check out the video, and please subscribe down below, because when you do, you'll be alerted every time there's new content from us. And we are actually going to be bringing new content to you, more exciting content, more interesting content to you, and we'll announce that soon. And when you do subscribe, we will alert you with new content whenever it comes out. And just a quick plug on next week's webinar. Finally, you won't have to see my face, and you'll be able to see the beautiful face of Xinting and Shengxi. Both of you beautiful, by the way. Xinting is our Chief Client Officer, and Shengxi is our Personal Finance Lead. And they'll be talking about a very interesting topic, tax hacks. So hacking is very popular these days, but how to pay less tax in a lawful way. And so that's the webinar coming up next week. We're going back to our regular Wednesday time, 7 p.m. And then just a quick intro for people who are new to us, joining us for the first time. Just introducing who Endowus is and what we are and what we do. The company is a digital wealth platform that was set up to solve the pain points that we ourselves all experience. I think Yulin talked about her experience in the past, but I was also in the institutional space for 26 years at Morgan Stanley Asset Management, where I was the Chief Investment Officer and the CEO across Asia. And there was a lot of trouble trying to invest my own money because of the lack of advice, the lack of access to good products, and of course the high cost of investing, which eats into your returns. And so Endowus is really here to help you save and invest better, so that you can live easier today and live better tomorrow, especially through and into your retirement. And so we became the first and only digital advisor for CPF money. And so we're the only digital platform through which you can invest not only your CPF money, but also your cash savings efficiently and effectively, and also what is the supplementary retirement scheme, which is the SRS, which is a very important tax saving device, which allows you to save for your retirement and benefit from tax savings this year. And the deadline is the end of this year, so we're running out of time this year. So please go and create your SRS account if you haven't done so. Look into it and start investing your SRS through Endowus. We'll move quickly through to the next few slides. And so I just explained how we became the first and only digital advisor for CPF. We focus on three things and try to do it well. So those things are advice, access, and cost. So we give you access, exclusive access at times to institutional share class funds, and also passive investing into CPF, which is exclusive to Endowus. We give you advice along the way to help you achieve better outcomes and reduce cost at every single layer so that you can benefit from that and achieve better outcomes. So in the world of Endowus, your goals are precisely defined, you have a process for achieving your goals, and you have access to the experts and strategies and products to achieve those goals. And with that, we'll go into today's hot topic.
Yes.
Lynn, finally, sorry I rambled on a bit.
Yep.
US election, yep, you're saying I rambled on?
No.
Okay, US elections and financial markets, which is the hot topic, right? So were you following the elections, Yulin?
Yes, I was. It's very stressful and it's very surprising, I would say. Not what I expected.
Right.
Yeah.
So, and it's been going back and forth over the past one day.
Yeah. Yeah.
We thought Trump had won it, and then Biden came back strongly, and now we're very uncertain about the outcome. So this is where we are. The next page, please. So we are at 264 for Biden, with very little opportunity to overturn other than Nevada, which is a traditional Democratic state. And so it's interesting that Biden, if he wins Nevada, which is the only state left in which he is leading, he makes exactly 270 votes, which is what's needed to achieve the electoral win. Trump has multiple ways, but he needs to win them all. I think at the moment, North Carolina and Georgia, Alaska, I don't know if they've been called since we began, but most likely will be Trump. If he wins Pennsylvania as well, that's 268. So if Biden wins Nevada and Trump wins the rest, that's 270 versus 268, which is probably the tightest, presidential election race we've seen in a while. And it raises a lot of concerns as well, because it could result in a contested outcome. And so the process, I wanted to show you a process through which the contested election will be resolved. And there are mechanisms in place and process in place to resolve it. So this is the answer to how this will proceed. So December 8th is the deadline in which the states can count or recount the ballots. And it looks like Trump will ask for a recount in a few of these states. And the dispute will be settled through a recount. If you remember 2000, when we had the last recount, none of them actually overturned, and eventually the Florida vote ended up, 572 vote difference was also upheld. So recounts are notoriously difficult to predict, obviously, but in most cases it's very unlikely to be overturned. Now, the other big problem we have is the mail-in ballots, which is a unique feature of the elections this year. And so those mail-in ballots, Republicans and Trump are trying to seize and not get counted. So we'll see how that plays out. But the next slide will show us that the timeline is pretty much set, and hopefully, if we don't get a result out in the next few day or two, with Nevada being called and the recounts happening, hopefully there aren't any legal disputes. But if Trump continues, then I think we may have some uncertainty still overlingering us over the next few days, if not for the next few weeks.
Yeah, and another layer of uncertainty is the Senate.
Yes.
Yeah.
So the Senate is, I mean, we haven't shown it here, but it's looking increasingly like the Republicans will take the majority again. We have three or four states that are still counting, but it looks like 51 for the Republicans. And so in that case, the Democrats will have failed in overturning and taking a majority. We were talking about a blue sweep, a Democratic sweep, right?
Yeah.
And I don't think it's going to happen.
Yeah, that's a bummer.
You're showing your allegiances right now. But
well.
so the next slide, we can go to some of the moving parts in the short term that has been raised because of the elections.
Yeah, so I know, Sam, you are very interested in US politics and also kind of macro picture. So I guess, going into the election, a lot of people are thinking and wondering what's going to happen to the market afterwards. In a short period of time, there's a lot of moving parts. COVID is still happening, and the stimulus package is still not out. And both Trump and Biden, their attitude towards China is harsh. It's just they take slightly different approach. So, based on all those differences and factors, what do you think is gonna kind of impact the market? Maybe in a short period of time, and then more kind of longer term. Yeah.
Yeah. So Yulin has just asked me to predict the markets.
Yeah,
which we don't do.
No,
at
we
Endowus,
don't do.
But
Yeah.
just for the sake of tonight and
Yes,
for
yes.
interest, we are going to have an educated guess, let's
Yes,
say,
yes.
and a discussion about what potential impacts these elections will have. And I think Yulin raised three areas which are very important, which is fiscal policy. The second thing is trade relations and geopolitics, especially with China.
Yep.
And what was the third one?
COVID.
COVID
But
and COVID and the impact on the economy. So we will
That
go
is
into a
very
bit more
difficult.
detail, but I think
Yeah.
policy is something that I think we can clearly talk about very easily, because the next slide shows a summary of what the Trump camp and Biden camp have been talking about in terms of the policies that they have. And there are stark differences, and it could lead to very different outcomes in terms of the impact on the economy. And because of the impact on the economy and the focus that each policies have, it will impact the financial markets in different ways.
Yep.
And different sectors within the financial markets. And so this is a very simple summary. It's not an exhaustive list, and it's definitely not something that is comprehensive. But I think the things that matter most is the fiscal policy. Related to that is the stimulus package. And related to that is tax, which is how you're going to fund these fiscal policies and stimuluses. Now, Trump is not a normal Republican because he wants to provide stimulus. Republicans are notoriously, anti-stimulus and fiscal spending. They want smaller government and government to spend less. Biden obviously wants to spend, and he thinks that we should spend in areas that are more productive, longer term. So infrastructure, job creation, transport, housing, and clean energy and areas like that. Now, the most likely outcome, let's just say, is Biden president and a divided Congress,
Yes,
right?
yes.
So in that scenario, which is the pink, and we wrote very little about that scenario, but the uncertainty will increase as a result. And while Biden and the executive part of the government will try to push for their agenda, which is stimulus and fiscal policy and raising taxes to fund it, they will be pushed back by Congress, right? In achieving their outcome. So we'll have something that's probably in between, which is not an optimal outcome. But it might not be so bad for financial markets, right?
I think, so in the short term, it's not so bad for the financial market, especially market doesn't like uncertainty. And now, it's kind of clear that it's going to be divided government, so market can already price that in, kind of price the unknown in the price already. But in the longer term, it's no one knows.
Yeah. So the one aspect that we are clear is that, if we have a Biden presidency, it'll be better than
Yeah.
Trump in terms of China and trade relations and geopolitics. So not just China, but the overall, global
Right.
positioning of America. And so hopefully that will reduce some risk and uncertainty on policy, American policy, foreign policy
Yep,
globally. But as you said earlier, China, you think, is probably not going to be as impacted. You think Biden will also remain relatively hawkish versus, history, I guess.
I think in terms of the trade relationship with China, so Trump is relatively unpredictable in his policy, whereas Biden seems that he will go down to a more kind of multilateral approach rather than unilaterally impose tariffs on China. So not sure how this will play out, but his policy past is definitely more certain and predictable than Trump, which is probably good for the market because market likes certainty and likes kind of predictable outcomes.
Right.
Yeah.
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 So we're hoping that things will improve at the margin, but we're not hopeful that things will go back to the norm that we had before.
Yeah, I
Yeah.
think the division and the confrontation between the two powers is just
It's a systematic problem.
Yeah, it's a structural
problem.
Yeah, yeah.
So if you move to the next slide on the three scenarios, once again, and we've gone into a little bit more detail with the cute Democratic and Republican logos, the donkey and the elephant. But if we just assume the first two are the most likely outcomes, and right now, as things stand, the first one is a more likely outcome, then I think that, in terms of financial markets, people will focus on quality growth. I think, tech may face some regulation. So in a Trump re-election, and the euphoric response initially yesterday when Trump was leading, we saw a very strong tech rebound in the market. And so, there is a little bit of tempering, I think, but I think overall, while there may be increased regulations, I don't think it's going to derail the systematic changes that we're seeing in the major industries. We will also see more predictable trade policy, so it may help emerging market assets, and a modest fiscal stimulus, whereas it might not be the kind of level at which we would expect it, I think will maybe add to yields a little bit and inflation expectations going into maybe next year, especially if the COVID situation improves or we find a vaccine at some point. Another thing that Biden has, spoken a lot about is ESG. So, Lynn, you're an expert in this field, and so I'm wondering, how are you seeing more interest from clients and, ESG?
Yeah, there's definitely a rise of ESG interest in Asia. It started in Europe before, and I'm really surprised and glad to see, people are increasingly interested and aware of ESG investing. And this is the trend. I mean, it's important, right, to kind of be conscientious about the environment that we live in.
Yeah.
Yeah.
Okay. So at this point, I just want to tell everybody that today we've moved to a new Q&A system called Slido. Many of you would be very familiar with it, but if you're not, then just type in sli.do, enter in your browser or your mobile phone, and then plug in the number, which is, what is the number? 29225. Thank you, Shengxi. 29225 is the number on Slido, so just type that in, and then when you do, you see the Trump versus Biden page come up. And also you will see two buttons at the top. One is Q&A, where you can leave questions, and you can upvote other good questions that other people may have left. But the other one on the right is the polls. So we have a live poll going on right now. We're asking you, what are you doing in the markets right now? Are you buying more stocks? Are you doing nothing? Are you increasing cash because you're conservative or worried? Or are you finding a middle ground by investing in fixed income or bonds? So please answer those questions now so that we can, take a look at how everybody is positioned. And then, also leave Q&A. I know most of you guys have been conditioned to use the YouTube channel, so apologize, but please use Slido to ask questions. And if you if you're still having hearing issues or sound issues, I think some people have told me that actually you can increase your volume to max and still not be able to hear very well. But in that case, you should actually go to the volume control on your YouTube channel on the bottom left. If you move your mouse, you have the pause button and the next shift button, but there's a mute button and a volume control button there. So maximize the volume control on your YouTube and maximize the volume on your electronic device, and hopefully that will solve the sound problem, because most people right now I think are okay with the sound. We are speaking to the mic and speaking at a high volume. So we're trying our best, guys. So please let us know. But try that volume button on the YouTube screen, which for some people may be reduced, and that may be causing the sound issue. So thank you very much, and we'll go to the questions. So we have upvoted a question: how will the credit markets be like post-election? Is there a difference between Trump and Biden? So that's the first question. And how will the Fed react to the result? Your thoughts. Both questions are related to interest rates and fixed income. So we can go back to the slides. And this is actually exactly what we just talked about, that if you look at it from a fiscal standpoint and the stimulus that is maybe coming, maybe not, it's something that the Senate will decide. But if that's the case, then I think we will see some creeping up in yields, especially in the long end of the curve, and maybe some steepening of the curve, and maybe some return of inflation expectations. But there's a big caveat, which is that the economy recovers, COVID situation improves a little bit, and there is some level of economic recovery that leads to inflationary expectations coming back from what is as yet still a very disinflationary environment. And so the Fed is unlikely to do anything anytime soon. I think that's the base case assumption most people have. I don't think that changes whether Biden wins or Trump wins, right?
No. Yeah.
So
I don't think so.
Yeah. So I think that's the question that was most popular. I think one thing that we mentioned was emerging markets. If Biden wins, maybe we see lower geopolitical risk and emerging markets does slightly better in an environment where the dollar also remains relatively weak. We will see emerging market asset classes and fixed income and especially their FX also backing up a slight appreciation, in which case emerging markets will do relatively better. And so, there was a question on the impact of emerging markets in China, and I think it's a relatively benign environment for emerging markets. And I think China is a tough one because as a component of emerging markets, it looks okay, but China has its own internal, issues, appreciating renminbi, highly indebted economy. But we've seen the economy recover very strongly since COVID. So it's doing quite well relatively versus the US certainly and many of the economies around the world. Yeah. So I think this relative versus the absolute, I think is the balance between whether you're bullish or a little bit more cautious about China. Anything you want to add on China?
Not really, but if we talk about the relative performance, between the US and China, I think it really depends on, first of all, how the trade war plays out, and second of all, domestically in the US, how the expectation and the reality of the tax hike plays out if Biden, wins in the end. Because that will be a negative for US market, which will make emerging market a bit more attractive.
Thank you, Lynn. Let's look at the poll. The poll result that we had. So we had, what are you doing in the markets right now? One was increasing cash. Second was buying more stocks. Third was buying more bonds. Fourth was nothing. And 33 people have voted so far. If you haven't voted, please vote now. And if you click it, you can see that almost half, slightly more, said nothing. And the other half said they're buying more stocks.
Wow,
Yeah,
okay.
very disciplined lot. But we also have 8% increase in cash.
Yeah.
So
Okay.
yeah, there's some uncertainty still, and there's some volatility. So people are a little concerned.
Yeah.
Please keep that vote coming in, and we'll take another pulse at the end. We'll have another poll later on. In the meantime, we'll go back to the presentation, but please keep, I think most people have now figured out Slido and have moved over to the Q&A, so please continue to keep that coming, and we'll remove the ones that we've answered, and then we'll come back to the Q&A slightly later. So Yulin, you want to go back to the presentation?
Okay, are you
page
done
16.
with the market commentary? Cool.
Yeah.
So that was an interesting result actually, because we were kind of expecting the opposite. This is what US investors are doing versus what we just saw of Singapore-based investors. So I guess generally people have concerns of heightened volatility of election, and probably will be more cautious around election time to protect themselves of the downside a bit more, and that's exactly what we saw around this time in the US. So this chart shows you a survey conducted by UBS, and as you can see, 63% of the US investors have tweaked their holdings to be more defensive. And this is true this year. And the next slide shows that this behavior is around for a long period of time. So historically, people also, would kind of buy a bit more kind of liquid cash funds, which is, more risk, lower risk, and less of the risky assets such as the equity funds. But then they would come back, kind of return to the normal investing behavior to expose themselves to risky assets, and less so to the money market funds after the election year. It's a very interesting result because it's surprising how an event like election has such an impact on investor behavior. And maybe you are not the same as them, but are you also kind of emotionally and in some other way affected by election? So this is also an interesting result from history. So people would always say, yes, there will be heightened volatility around election, because there's a lot of uncertainty going around. Whereas historically, actually before and after the election, the volatility, the annualized volatility of the US market, which is represented here by the S&P 500 index, is lower than kind of the full time period of the market. So it just tells you like how we can all have this bias and the recency bias of kind of the event happening around us, whereas the truth is not really the same as what you might think.
It's interesting, and you mentioned Singapore-based investors, but I think it's the difference between US investors in general and our highly educated and intelligent investors who are actually joining us today. Potentially.
Yeah.
We'll move very quickly over the next few slides because we want to learn from history, and there have been many elections in the US before. So Yulin's going to run through very quickly how history has taught us about what happened during elections, after the elections, and what president did what, and answer the question whether markets do better during a Republican or a Democratic president. Yes.
Okay. So history always tells us a lot of things, and this is no exception. So this slide shows kind of the historical monthly return of the market since a long time ago. I'm trying to see, but
I don't think we put it in the charts.
Yeah, we didn't put it here. Sorry, guys. But it's like so it uses the CSRP index, which is the longest history of the market. It's probably like over 100 years already.
Yeah,
Yeah.
probably looking at the number of months that have been stacked on top of each other. Yeah.
So overall, you can see actually the market return follows a pretty normal distribution, with most return in between kind of the first, like negative 5% to positive 5% on a monthly basis. And those little bars that you can see, they mark the presidential month. So the red represents Republican won, and the blue represented that month a Democrat won. So this is it kind of follows the pattern as well, whereas it's slightly skewed to the right actually, which means it's kind of positively skewed. It's kind of generating positive return, but overall, it tells us that it's random, just like how random market is.
And also, Yulin, actually, I just counted how many lines there are, and there's 23, which is 23 elections.
Yeah, times 4.
And times 4, roughly. Sometimes it's less, so it's 96.
90, yeah.
So that's, you're right,
92.
almost 100 years, 92.
Yeah.
Sorry, I can't do my maths.
Yeah.
Your brain is younger than mine.
No.
So you see all the different months, and as Yulin highlighted, it's really interesting that the average is actually slightly to the right and positive. Most of it is between -5 and +5, and of course there are really extreme black swan events on the positive side, and the negative side it peaks up.
Yeah.
But in general, that normal distribution holds out in markets. And as Julian highlighted, in the single month of the election month, really the returns are very, very random.
It is, yeah. It's super random, but it's only a monthly return, right? Some people might wonder, okay, how about the year? How does the election year play out? Again, it's insignificant. There is no relationship between the election year and the market return. So this is a chart that shows you a portfolio of 60-40, 60% stocks and 40% bond. And the election year is marked in purple. So it kind of goes back and up, goes up and down, just kind of randomly. And on average, it's actually done better than the non-election years, 8.9% versus 8.1%. But again, this is statistically insignificant. The 0.8% difference might just be because of random factors. It's not that it definitely does better than the non-election years. And then moving forward to an even longer horizon, investment horizon. So this is actually the past 100 year. And whether the Democratic or Republican president wins, it really doesn't matter to the overall direction of the market. The market just kept going up. Of course, there will be period of recession or like special events that happened. So we can go through some of the kind of
recent precedents.
Yeah, recent precedents, and take a look at how market performed and how the economy did under each president. So Donald Trump, we know that its market has done well, but then the market sank into a recession because of COVID. But it has nothing to do with Trump. It's health.
Or his policies.
Yeah, like when he inaugurated, right? No one could have forecasted a COVID crisis. And then Obama, again, he's lucky because the market was just coming back, the economy and the market was just coming back from the financial crisis. So yeah, this is pretty good. The market was steadily up.
And it's a Democratic president, and it had no impact.
Exactly.
And many people actually think that Republican presidents are better, but this next slide, obviously, is George Bush, and he's obviously a Republican president.
And very unlucky president. The timing is perfect for, because it began when the tech bubble just bursted, and it finished when the global financial crisis is kind of at the bottom.
And yet, the total loss during that whole period was only minus 18%.
That is true. Yeah.
And this is called the lost decade.
Yeah.
When S&P 500 actually underperformed every other major global indices.
Yeah.
Yeah.
Yep. And this one, the last one is again Clinton, a name that a lot of us would be familiar with.
And probably one of the most luckiest guys ever,
Yeah.
because he presided over the largest financial returns
Yep.
of any president, actually, right?
Exactly. Yeah. So this is a summary. This is a summary of how the market has performed under each presidency. So it's cumulative return over the 4-year period of the president. It's pretty interesting and consistent with the past experience that most of the time market has gone up to a different degrees. And when the market has gone down, there's usually a reason to that. You know, the financial crisis, that's Bush's experience, and before, I think, the Great Depression as well.
Yeah.
Yeah.
So this is really interesting because every single president, and it's not 4 years, but sometimes it's, you know,
Yeah,
8
true,
years,
8
sometimes
years,
it's 2
yeah.
years. Roosevelt was the longest serving president in history. But the three minuses are Hoover, the Great Depression, Nixon, which many of Endowus fans would know because of my presentation on Barton Biggs, is 1973, when Nixon resigned and, you know, the oil crisis happened and the dollar left the gold standard. And Bush, the global financial crisis. But apart from those extreme cases, every single president, it doesn't matter whether it's Republican or Democrat, every single president returned a positive and meaningfully positive return in financial markets.
Yeah.
And so I think that's the most important takeaway from all of this is this chart. Okay, so we move to the next slide, which also shows, you know, which is a familiar slide for many of us, but regurgitates and repeats some of that points that we just made, which is that, you know, the bull markets tend to last much longer and go up much more than we think, and the bear markets are actually typically only 12 months to 18 months long. The most recent one being, you know, just 1.5 months long. So, you know, we have to understand history and the history of financial markets to better understand the big picture when we are investing our money.
Yeah. Yeah. So here are just some common myths on the U.S. election and the markets, which would lead to, you know, unwise investment behavior potentially. So as we said, election year or month, it doesn't necessarily expose the financial market to lower return. It's mostly random, and on the contrary of, you know, exposing it to higher volatility, historically it has been kind of the volatility has been slightly lower. And we don't really know whether the market will perform better or worse under different political party. Again, what we can really know and we have seen is that it's a random pattern which follows the broad market. And just another point here as well, just, you know, like election is really just one of the many events that's happening in the market. At all times, there is just so many different things that's going on that's kind of interplaying and affecting the market. So, but we all have the recency bias. We all feel that, you know, this time is so different. You know, we're in a COVID crisis, and this division in the US is kind of growing, and something is going to change and something is going to be different. But history has gone through all of this, and we can have more certainty than uncertainty that this time is not that different from what's happened in the past. Yeah.
Okay, sounds good. Next page. So we're going to talk about briefly where we are now in this cycle. You can see that in terms of volatility, which is where a lot of people focus, because people think that volatility will be higher during an election year, especially this year because there's so much uncertainty about the outcome, and even now. And maybe that is one reason why the VIX index, which is the blue line, which is the typical index, and versus the 5-year average, we've seen the VIX index remain relatively low almost at historical low levels in 2017, and again as we came into this year. Obviously, it spiked up suddenly during COVID, and then it came down gradually as markets recovered. But it's actually at quite elevated levels. The numbers right now are similar to where it was in 2018, beginning at the end, when it spiked up to multi-year highs. So the VIX index right now is pricing in some level of volatility that is relatively higher, and you can see that in the recent financial performance, because the markets, after falling very rapidly and then recovering very quickly, has largely been at or near the historic high, but we have not been able to push forward to historic high levels. What this chart shows you is that there is uncertainty about the outcome of the election, but also uncertainty about the economy. There's uncertainty about how this COVID situation plays out. And those are all things that contribute to a higher level of volatility and uncertainty. But the other thing this chart also shows is that, versus equities, which is a highly volatile, asset class, we have seen, the fixed income market, although shortly disrupted during March, recover very quickly and be relatively stable. And it goes to the point about how diversification allows us to have a balanced portfolio that reduces volatility over time. Now, if we turn from markets to the economy, you can see that this is the latest US GDP numbers that just got published. They recorded a historic high 33% annualized gain. Obviously, it comes off of a massive fall, a drop-off in growth activities during the COVID crisis. And obviously, we're not back to where we should be. But this is exactly why economics and GDP numbers are not a good predictor of markets, and why we say the stock market is a leading indicator of financial markets, and equity markets is a leading indicator of the economy, is precisely because the economy lags, and the data lags the actual activities in the economy. And so the financial markets have moved. They fell before we could even call recession, and it recovered before the economy even fell, and before any of these data became available. And so it's important for us to know that financial markets is an effective pricing mechanism of all the news that's out there, but also it is a leading indicator of economic activity and the real economy. And this rebound has been largely driven by the retail sector. So the US consumer remains the very strong kind of foundation upon which the US economy is founded and is driven. And in fact, it has more than recovered the fall during COVID. And some of this can be, attributed to online activities like Amazon, etc. But also in general, I think the US consumer is in a much better place. Household balance sheets have repaired itself because they're not spending as much maybe, and asset prices have recovered across multiple different asset classes, and the economy across the globe likewise is recovering from the lows. And actually, I think many of the emerging markets, and especially Asia, we know because we're here. We see it that the economic activity is recovering to much more normalized levels, and the economic rebound will be sharper for many of them. For some economies like Taiwan and Korea and some parts of China, they're back to the previous highs, and some of them didn't actually even fall that much. For the emerging economies like Brazil and India, where we had a very sharp case of COVID, as that recedes, I think the economic activity is rebounding very sharply. But developed markets, as we will see in the next chart, we're going to see an extended period of uncertainty because we are seeing a second wave or a third wave in some countries of COVID cases. And the UK has just shut down its economy. US also, we may see more curbs, especially if Biden becomes president. And many of the European economies are also seeing a rebound. And this is the uncertainty that is prevalent when we are looking at financial markets and investing in financial markets. And that's why it's so important to know what is under your control and what is not under your control. What you can control is your career, Yulian, you can control at Endowus and into your future. You can control your asset allocation and diversification. You can control your investment costs, and you can control your behavior. What you cannot control is the US election outcome. I mean, no one can control that or even predict it. And the prediction has changed multiple times, even in the past 24 hours. We cannot control COVID. We thought it was going away. It's coming back. You know, maybe it's going to come back in the winter. Maybe we'll see a vaccine and all of this disappears. We don't know. The economy, we talked about the stock market returns and short-term movements in individual stocks. My friend just sold his Tesla and he's kicking himself because it rebounded strongly for 2 days. And we don't know what's going to happen in the future with Tesla even, right? So I think we really need to focus on what we can control and you know, be better investors as a result of it. At this point, I just want to maybe touch on a few things just as a reminder, which is these are all very familiar slides for people who have joined our conference webinar before. So I'll be very quick and then we'll go to the Q&A. So the next page, what we can control is cost. Obviously, cost compounds as well as returns. And even a 1% difference could result in 250% returns difference over 30 years. Next one, we can see that clearly you should not be trying to time the market. As we saw during COVID, if you sold out and were out of the market at the bottom of the market, you would have missed out on one of the strongest and fastest rebounds in the history of mankind. And so this chart shows you exactly what happens if you miss just a few days in markets. Over 50 years, if you miss 1 day or 5 days or 15 days, your returns dramatically drop. And so missing just 25 days or barely over a month out of a 50-year period, then your returns drop by, you know, a factor of 1 in 5, right? 20% or less. My math is not very good today.
20%. Yep.
So the next slide also, we can show that, you know, market returns and the volatility that people are worried about is something that is very short term. If you invest for the long term, the returns aggregate to a mean return that is 7% or 10% depending on which indices you invest in. And the thing that you can also control is diversification. So we showed what the bond index did while the equity market moved. And in every single recession, especially when you most need it, diversification works. And diversifying asset classes, diversifying geographies, and diversifying your exposure reduces volatility and improve outcomes over the long term. But more importantly, what it helps you do is to control your behavior, control your emotions, because you won't be panicking, because you know that the markets will return and the less volatility will help you make a better emotional and cognitive decision.
Yep.
You want to talk about this?
Yep. Just, you know, I think a lot of focus around this time has been on the US market, but there is a lot more choices even just outside of the US. So it's always good to diversify your holdings to other sectors, to other countries, and to other asset classes. So this chart shows you kind of correlation between the US market and say Asia market, emerging Latin American market, and the bond. And you can see, especially for bond, the correlation is really low. It's like below 0.1%. That means massive improvement on kind of the risk profile of your portfolio. And even for an Asia kind of index, the correlation is below 1. So as long as the correlation between two assets is below 1, it is a diversifier, and it will improve the return and risk profile of one's portfolio. Yeah.
So we'll go back to the Q&A for a little while before we finish up. There's some questions that have come through on the elections and also on investing because we just talked about it. But maybe we just address the first ones, the higher voted one. I think this is Jimmy. What will happen to the ongoing trade wars, if any, if Biden wins the election? I think there's another question down here. Given that both Trump and Biden share similar attitudes on EM, how will either of the possible scenario iterations affect the rising powerhouses? And then one final question that's similar is there were news of Mike Pompeo's visit to various countries, seen as an attempt to garner allies against China. How will a civil war, if broke out, affect us? Okay, let's leave the civil war out, but maybe the the alliance against China compared to the trade wars, and then the attitude towards emerging markets. If we wrap that together, I think very briefly we can talk about how in a Biden winning scenario, I think some of this very inflammatory rhetoric that comes from Trump will die down. I don't know whether that will immediately result in a better relationship, but I think that Xi Jinping and also President Xi Jinping and also Biden will try to work better together. I think they may have actually a better rapport, knowing that Biden as a vice president during the Obama administration had a better relationship with Xi. And so we will see an improved relationship with China, probably a more stable geopolitics with the rest of the global countries. But as Yulian highlighted, I think the strategic and the structural changes where China and the US continue to compete, and where they will be a little bit conflicting in their agenda, I think that will not change. I don't think we will see Mike Pompeo or the next Secretary of State flying around garnering support against China to that degree. I think that may not happen, but I think that structural problem will persist. Anything you want to add?
No, I think you covered it really well. And yeah, as I said before, I think the relationship can be a bit more stable than the Trump period, and there will be more predictability, and Biden will potentially work with other countries together to coerce China together though. So yeah.
Okay. Sounds good. And then some questions about, okay, did either candidate mention how they will be addressing the US's ever-expanding debt? Will all the stimulus a risk of severe currency devaluation or hyperinflation? And then will markets crash after one of them win? A civil war looks likely to happen. Riots and COVID increasing towards end of the year. So I think those things. And you mentioned, okay, so that one I think we'll answer later in terms of investments. So I think, the ever-expanding debt, fiscal deficit, the twin deficit as we call it, a current account deficit, which is trade and money flows. And the second one is the fiscal deficit, which is the government's balance sheet. On both accounts, US runs a deficit, which is why it's called a twin deficit. Unlike the current account, which is funded by US dollar printing effectively and issuance of bonds, the fiscal deficit is something that is very structural. The US has a very, very low tax rate in terms of corporate contributions to tax. Is really largely coming from income tax and financial taxes. It doesn't come from corporations. Most companies avoid taxes in a major way. And furthermore, when Trump came in, he cut taxes quite dramatically at every level, income tax as well as corporate tax. And so if you do that, if taxes is the most important source of income and funding for fiscal spending, then obviously the deficit will widen. And I don't think that would change whether Trump or Biden comes in, because the legislations that need to be made to change these systems and raise taxes is not going to happen fast enough. So there is a major lag before the deficits can be restored. Now, the economy causes additional burden. So during COVID, activities falls, profitability falls, taxes fall, and during a time when, obviously spending in social welfare and other things also pick up, and therefore the fiscal deficit worsens even more. Yeah. So from this low level, cyclically, I think things will improve, but structurally, things will still remain pretty bad. And as a result of that, what happens is this increasing concern about the dollar as a reserve currency status, about possibly devaluation, and long-term concerns about inflation or hyperinflation or stagflation. to be honest with you, I don't see inflation rushing back anytime soon. So the worries about stagflation and hyperinflation, I think, are probably misplaced for a country like United States, which, because of its aging population, has very natural disinflationary forces. And in terms of currency, I think that the US probably will not lose its reserve currency status anytime soon, because still all financial markets are controlled by and transacted mostly in the US dollar. Trade is also very dominantly US dollar focused. And so I don't think those reserve currency status will change anytime soon, but it is gradually being eroded. And the US is not doing itself any favors. And as a result, over time, I think the US dollar may continue to weaken. And that is a cause for concern, and why people are looking at things like gold, which is an anti-dollar play, or looking at cryptocurrency, which is an anti-dollar trade, or you can buy any other emerging market currencies like Sing dollar, which over time always seems to appreciate against the US dollar. If I can just wrap up the slides here before we go back. I just answered the midterm outlook for the US dollar for the question that came up just now, which is that over time it's more likely to weaken rather than strengthen. But currencies is always a relative question, right? Against what currency, against what asset class? So if you're talking about US dollar versus Chinese yuan, renminbi, then obviously, maybe the US dollar weakens, renminbi strengthens over time, over multiple decade scenarios, and maybe against the Sing dollars it weakens, but maybe against other emerging markets, US dollar strengthens. So I think it's always a relative game. But money is meant to enable your life, not control your life. So as I mentioned, that focus on the things you can control, focus on the things that matter to you. And you need a reliable partner to help you in your investing journey, to do the hard work for you, so that we make investing easier for you. And as Endowus is the only digital wealth partner that can manage all your source of funds here in Singapore efficiently. You can invest your CPF away with us, your cash savings with us, and SRS with us. And just another plug for SRS. Our personal lead, finance lead, Sheng-Shi, is a big proponent of SRS, and he'll talk about it next week. But SRS is a seasonal, opportunity that we should seize. But also, using all of these, source of funds, it's really important to have, your buckets of money that is appropriate for the goals and the needs that you have in the future, and against the compensated risk that you're taking in order to get the returns you deserve. So we have different pots. The previous one is the pots of money that we have: the short-term cash management, liquidity, the medium-term goals, and the long-term goals like retirement, where we need to have different asset allocation. And for your short-term cash management, we do want to talk about the Cash Smart solution, which we launched earlier this year, which gives you enhanced yield, much better than bank deposit rates, and allows you to have daily liquidity, no cost to transactions, putting your money in and out, and there's daily accrual of interest. So you can get interest on the exact days that you have invested in Cash Smart, and take it out at any time that you want to. So we're going to go back to the questions again at this point. Any final thoughts before we move on, Yulin?
No, let's go to the questions.
Okay. So you mentioned don't time the market. So even if elections are so volatile, is it advisable to just still go in?
Yes.
Simple answer to a
That's
simple
the
question.
That's the answer.
But I mean, it's daunting, right?
Yeah,
Try if you have a pot of money. If it's a lump sum, you have like say $50,000 or $20,000 saved up, and the markets are volatile like it is these days. What is the right thing to do you think, Yulin? How much would you put in as a lump sum, and how much would you put in like spaced out over a few months or a few weeks?
Okay, rationally, I know I should do it lump sum, because then, first of all, I don't know where the market is going. It could just go higher and I would just regret of not putting all my money in. Or it could go lower, and at that point of time, I would also regret for putting my money in earlier than I should have, right?
But hopefully you would have been paid your monthly salary from Endowus, and you can put it to dollar
Yeah.
cost average.
Yeah, yeah. So I think like rationally I would put a lump sum in and I probably will do so. But for those who are more scared, you can, kind of dollar cost your investment by putting a bit now and maybe another 20% in a month's time and another 20% in a month's time. So you kind of average out the volatility in the market. Although I think empirically it doesn't really make such a difference, or it's even a bit inferior to lump sum investing your money because basically you lose out time in the market. Yeah.
Yeah, it's great. I completely agree because it's an emotional and personal decision. You're trying to help yourself be better behaved, meaning that you can be more disciplined in implementing your personal financial plan by investing on a regular basis.
Yeah.
And it's really important that when you set that plan, it could be 50% of your total lump sum, or it could be 70%, or it could be as low as 30%. But figure out how long you want to take to be fully invested in markets and stick to that plan regardless of what the market does, so that you don't have this emotional
up
roller
and
coaster.
down.
Yeah.
Yeah.
Right. Okay. So there's a few questions about how bonds and equities are positively and strongly correlated. And there are some buzz of modern portfolio monetary theory. Is this legit? Does this even have a chance to be adopted? I lumped those two together because it seems like they are somewhat related, because it's about asset allocation, it's about correlations, it's about diversification, which is the only free lunch in finance.
Yep.
That's what modern portfolio theory teaches us. And so I think there's similarities in this question. And bonds and equities recently are highly correlated, but so is gold, so is private equity, so is real estate, so is pretty much every risk asset that is out there. And the reason it's correlated is because I think the money flow, the liquidity that has been caused by quantitative easing and money printing globally has just led to a much more kind of monetarist kind of theory of asset class, assets and financial markets. And so what we are seeing is that gold, which is supposed to be an uncorrelated asset class, or real estate or private equity or fixed income, are being much more highly correlated to even crypto is much more highly correlated to equities. And as a result, my counter argument would be, why not equities? Because equities, everybody says, is expensive, but what isn't expensive out there? Is property prices so cheap we should sell equities to buy properties? Is gold so cheap that we should buy it? What's the counter argument to this argument that they're correlated? I think it's something that we started seeing in 2008 when markets fell and rebounded together and correlation went to 1. It's something that happens in any crisis. It happened again in March. It happened in 2018 when we saw markets correct. So I don't think it's something that is new. I don't think it's something that is like something that we need to be concerned about. I think it's difficult to find uncorrelated or low correlated assets. What we can do, and this is why modern portfolio theory still works, is because what we showed earlier about the geographic diversification alone within equities, low correlation. Even between equities and fixed income, we showed you charts that every single recession, including this year, fixed income didn't fall as much and recovered much faster to end with a positive number. So I think what you have to understand is that short term, when it's a month or whether it's 3 months, the correlation does rise. But over a longer period of time, the correlation is low, and as a result, it actually helps you in diversification and creating a better portfolio.
Completely agree.
Okay, so one more question on, can you add funds in CashSmart to park it there, and then when you want to decide to transfer from there into your Endowus portfolios? Yes, you can. We're still working on a seamless transition from your CashSmart to your investment portfolios or funds, but you can transfer. But at the moment, I think the faster way to do it is to just to redeem. and then transfer it over to an investment portfolio. But you can do that quite seamlessly on the Endowus platform. So please try it out. If you have any questions, please reach out to support@endowus.com. You can see below on the YouTube channel that you can arrange a call with an MAS licensed representative from Endowus if you have any questions or would like to seek advice about how to invest. Many of these questions related to investing, you can reach out to our MAS licensed reps and they'll be happy to answer your questions. Okay, as an existing user, was wondering what are the key difference between Cash Smart options versus the FundSmart cash management option. So FundSmart is a solution that we just released, and it also, there's another question that says, so how should I invest? I mean, RSP being regular savings plans, into multiple funds, or is there a way to diversify my funds? And both are related. So it's not a Cash Smart question. I'll answer that afterwards, Lapasa. But I think initially what you want to do is allocate your funds into a core allocation of equities and fixed income, which is what our advised portfolio is. That is the backstop to which you need to build your total portfolio. So the core allocation should be to the globally diversified low-cost portfolios that Endowus has. And then you can add to that with satellite positions. That could be ESG, value-driven portfolios, or other alpha strategies, or other strategies that you may have. In that, when you want to do that, you need to use the FundSmart function. And there you have a lot of customizable funds that you can build into portfolios. We have advisory tools that will help you get to the portfolio creation with a lot of information about the risks, the projected outcomes, the historical returns of the overall portfolio as opposed to single funds. So it's a very powerful tool. I don't think people fully understand or use it effectively, but whatever you build, you can put in whichever funds at whichever ratio. The moment you do that and add an amount that you want to invest, the engine would run and give you outputs that are really, really helpful in deciding whether this is suitable for you. So please try that out. And to Lapasa's question about Cash Smart options, we have built the 1% core allocation for Cash Smart and the 2% targeting enhanced Cash Smart product. And so those are two products that we feel very confidently, if you want lower risk and yet better returns and yields than your bank's current account or your Sing saving bonds, whatever it is, it's very difficult to get 1% at low risk. This is the low risk way to get 1% through a cash fund, institutional bank deposits, and also money market type funds. You can achieve almost a 1% or slightly above 1% yield from that product. The enhanced product is a 2% targeting yield. Now what FundSmart is it gives you the option of creating something that is safer than the 1% with zero risk of loss by using the single Fullerton fund, or you can target something in between the 1% and 2%. Maybe you want something that's about 1.25%, or you can actually create what we presented at the FundSmart presentation, and I would advise everybody who's interested to look at that webinar with Greg, is something like the Cash Smart Ultra that we created for fun. But I think since then, a lot of people have asked us about this Cash Smart Ultra. But you can achieve through a high exposure to fixed income, higher exposure to short duration risk, you can actually achieve plus more than 2%, 2.3% type of return. So what FundSmart is customizable and personalized and risk adjusted portfolios for your cash management and also your core investment needs. So with that, I think we should wrap up. Maybe a quick plug for next week's session again. So going back to our Wednesday session, 11th November at 7 p.m. We will have our Chief Client Officer Sinting and our Personal Finance Lead Sheng-Shi joining us on tax hacks, how to pay less in taxes lawfully. And finally, a very quick plug on our mobile app. So if you didn't know, then you know that we have launched an Endowus mobile app. So please check it out on App Store or the Google Play Store. And with that, Yulin, thank you so much.
Thanks. Thank you very much for tonight as well.
Okay, I hope you guys enjoyed it. Please follow up with any questions that you may have, and also reach out to support@endowus.com for any questions, or go back down to schedule a call with one of our MAS license reps. Speak up. Thank you so much, everybody, for joining us tonight, and have a wonderful evening.
Thank you guys, and see you next week.